Welcome to The Explainer. Today, we're untangling a truly fascinating corporate mystery. We're looking at Nike's fiscal 2026 fourth quarter, and honestly, it is a total masterclass in reading between the lines. So let's just push past the flashy headlines together and uncover what's actually happening inside the world's biggest athletic brand.
Okay, let's dive right into this, because this is the central mystery we really need to solve today. If you just read the top-line bullet points of Nike's press release, you'd think, wow, they hit it absolutely out of the park. They reported a massive 407% net income jump compared to the same period last year. Net income literally soared to $1.1 billion. That's a huge earnings beat, right? But almost immediately after this news dropped, retail and institutional investors alike just smashed the sell button. They sent Nike stock plummeting in after-hours trading to around $40.75. That is a brutal 10-year low. So you've got to wonder, how on earth does a massive profit spike trigger a total stock collapse? Well, to understand why, we have to look directly at the source. When you strip away that bottom line profit and just look at the actual sales, the revenue, the picture changes completely. Overall, Q4 revenues were actually down 1% on a reported basis, coming in at $11 billion. Now, as you know, in a healthy, growing company, you really want to see that top-line revenue expanding. A shrinking top line? Yeah, that's the first major signal to the market that this massive earnings beat isn't exactly what it seems. Basically, their core business of actually selling shoes and shirts, well, it contracted. Which brings us to the first major clue in our investigation. And wow, it is a staggering number. $986 million. So where did this even come from? Well, the Supreme Court recently ruled that certain U.S. tariffs, ones imposed under the International Emergency Economic Powers Act, or IEEPA, were unauthorized. Because of this ruling, Nike expects to recover a massive chunk of the tariffs they've previously paid. And this one-time $986 million windfall, it was injected directly into their Q4 results. This single event artificially inflated Nike's gross margins for the quarter by nearly 900 basis points. That is a massive 9% bump, pushing them up to a really impressive-sounding 49.2%.
And what's really interesting about this is how perfectly the data exposes the illusion here. When we break down the earnings per share, or EPS, Nike reported 72 cents per share. On paper, that completely crushed analyst estimates, which were sitting at just 13 cents. But take a closer look at the composition of that 72 cents. A full 52 cents of that total is exclusively from that one-time expected tariff recovery. If you subtract that 52-cent windfall, man, the underlying operational earnings per share were radically softer. We're talking just 20 cents. So the market realized instantly that Nike didn't suddenly become wildly more profitable at selling sneakers. Nope, they just got a massive government refund check.
Part 1. A tale of two markets. Let's briefly look at the geographic divide.
Right, so once you strip away all that tariff noise, you're face-to-face with the operational reality. In North America, which is their largest market, they managed to squeeze out a pretty modest 3% growth, hitting $4.83 billion. They did see some momentum there with wholesale partners, which is good, but that modest win was heavily overshadowed by the data coming out of Greater China. Sales in Greater China suffered a really painful 12% drop, falling to $1.3 billion. Actually, footwear sales in China alone fell 13%. And Nike has historically relied on China as this massive growth engine, so seeing a double-digit contraction there, yeah, that's a severe red flag for investors.
And underneath those geographic struggles lies a really fundamental product struggle. Nike's portfolio is kind of split into two distinct camps right now. On one side, you've got the classic lifestyle franchises. Think of your everyday Air Force Ones or Dunks. Well, those are facing double-digit declines. Consumers are just pulling back. But then on the flip side, their performance gear, like the actual equipment people use to play sports, is doing really well. For example, performance running saw a growth of over 20% in the quarter. But here's the catch. Because those classic lifestyle shoes make up such a massive portion of their overall revenue, those performance wins just simply aren't enough to carry the whole company right now.
Part 2. The Win Now strategy. Here's management's turnaround plan.
So management is acutely aware that the old playbook just isn't working anymore. To address these underlying structural issues, CEO Elliott Hill and CFO Matt Friend have kicked off an urgent, highly aggressive turnaround plan. The crucial point here is that fixing a foundation this large requires some incredibly painful near-term steps. We're talking 4 big ones. First, they're intentionally pulling back on those declining classic footwear franchises just to clear out unhealthy inventory. And honestly, this alone cost them about 5 points of growth. Second, they're shifting back to a sport offense, really focusing heavily on that performance gear where they're actually seeing that 20% growth we just talked about. Third, after years of focusing mostly on their own direct-to-consumer digital sales, they're now desperately trying to rebuild bridges with traditional wholesale partners. Think Foot Locker or Dick's Sporting Goods. And finally, they're resetting their massive fixed cost base. This included taking a very heavy $230 million charge this quarter just for employee severance.
And I think this brilliantly illustrates the sheer difficulty of what they're actually attempting. During the earnings call, CEO Elliott Hill shared this incredibly evocative metaphor. He talked about standing on the pitch at Camp Nou, right? The legendary stadium of FC Barcelona. Right now, Camp Nou is completely covered in scaffolding and cranes. They're entirely rebuilding the stadium to hold 100,000 fans. Yet capacity is currently super limited, and the team, they still have to step out onto that half-built pitch and try to win matches today. As Hill put it, FC Barcelona did not choose between performing in the present and preparing for the future. This is Nike right now. It's like a giant puzzle. They're trying to execute these massive disruptive structural repairs while still fighting tooth and nail for market share every single day.
Which brings us right back to the market's absolutely brutal verdict, $40.75. Look, despite the poetry of that Camp Nou metaphor, and despite that billion-dollar tariff windfall totally inflating the net income, Wall Street wasn't buying it. They looked at the shrinking revenues, the collapsing Chinese market, and the heavy, heavy costs of this win-now transition, and they sold. Retail investors pushed the stock down 32% year-to-date, dropping it straight to that 10-year low.
The main takeaway here is pretty crystal clear. The market completely saw through that one-time tariff bump. Investors aren't looking at the past, they're looking at the future. And right now, they are aggressively punishing Nike for the painful long-term reality of their current rebuild. Because let's face it, rebuilding a brand, clearing out billions in old inventory, and repairing relationships with retailers, that takes time. Management says they expect to complete these win-now actions by the end of the calendar year. But until then, patience is absolutely required. And as we all know, patience is something the stock market notoriously lacks.
So, we're left with a massive question to ponder. Will Elliott Hill's Camp Nou rebuild strategy successfully restore this athletic giant to its former glory? Or is this loss of market share, especially in vital regions like Greater China, a permanent shift in the global footwear landscape? Only time will tell if the foundation they're pouring today will actually hold up tomorrow. Thanks so much for joining us for this explainer. Keep your eyes on the data, and we'll see you next time.